Let me ask you something. Have you ever thought about what your life could look like at 60 if you started investing today? Even if you only have $100 a month, by the time you retire, you could easily have over $500,000, maybe even $1 million, thanks to the magic of compounding. Sounds too good to be true, right? Sure it is. But here's the thing. Most people delay investing because they're scared, confused, or think they need a lot of money to start. In this video, I'm going to break it all down. I'll show you exactly how to invest for retirement in your 20s and 30s, step by step. We'll talk about where to put your money, how much to save, and how to make your investments grow automatically over time. By the end of this video, you'll know how to start small, stay consistent, and use strategies that have worked for millions of Americans, even if you've never invested a single dollar before. Stay with me. Starting early can make all the difference. Hello, welcome to EduTech Finance channel, where we teach the smart way to grow your finance. Please subscribe to the channel. Why starting early matters. Let's talk about why starting early is so powerful. There's a phrase in investing, time in the market beats timing the market. Imagine this. You start investing $100 a month at age 25 with an average annual return of 10%. That's a reasonable expectation for the stock market over decades. By the time you're 65, you could have roughly $600,000. Now let's say you wait until 30 and start investing the same $100 per month. By 65, you'd only have about $300,000, half as much. That's the power of compounding. Your money doesn't just sit there, it grows exponentially over time. It's not about being rich overnight, it's about building something slowly and consistently. And here's the best part. The earlier you start, the less stress you'll have later. You won't have to try to catch up in your 40s or 50s. Your future self will thank you. Next, let's talk about the types of retirement accounts you can use to grow your money. In the US, there are 3 big ones beginners should know. 1. 401k, usually offered through your employer. You contribute pre-tax dollars, your investments grow tax-deferred, and many employers even match part of your contribution. That's literally free money. 2. Roth IRA. You pay taxes up front on the money you contribute, but everything grows tax-free. This is powerful if you expect to be in a higher tax bracket when you retire. 3. Traditional IRA. You get a tax deduction when you contribute, and your money grows tax-deferred, but you pay taxes when you withdraw in retirement. Each has its pros and cons, and sometimes you can even use both. The key is, don't overcomplicate it. Pick 1 or 2 accounts and start contributing consistently. Even $50 to $100 per month is better than nothing. Setting realistic goals. Before you start investing, it's important to set some realistic goals. Ask yourself, at what age do I want to retire? How much money will I need to live comfortably? How much can I save each month without feeling stressed? A simple rule of thumb is the rule of 25. Take your desired annual retirement expenses and multiply by 25. That's roughly how much you'll need to retire comfortably. For example, if you want $4,000 per month in retirement, you'd need $48,000 per year. Multiply that by 25, and you're looking at about $1.2 million. That might sound scary, but if you start early and invest consistently, it's completely achievable. The key is to start small and stay consistent. Even investing $100, $200 per month can grow into a sizable nest egg over decades. Investing strategy for beginners. Now let's talk about how to invest your money. For beginners, the best approach is usually simple and low cost. Asset allocation. This is how you divide your money between stocks, bonds, and cash. Younger investors usually focus more on stocks because they have time to ride out market ups and downs. Index funds and ETFs. These are perfect for beginners. They automatically invest in hundreds of companies at once, giving you instant diversification. You don't have to pick individual stocks, the fund does it for you. For example, investing in an S&P 500 ETF means you own tiny pieces of 500 of the largest companies in the US. It's a safe, proven way to grow your money. Choosing a brokerage. Look for low fees, beginner-friendly platforms like Vanguard, Fidelity, or Betterment. Some apps even let you automate your investments, which brings us to our next point: how to automate investing. Automation is a game changer. It removes the temptation to spend your investment money and ensures you stay consistent. Set up automatic contributions from your paycheck or bank account. Even $100 to $200 per month, automated, adds up over time. You won't notice it missing, but your future self will. Automation also helps you avoid emotional investing. You won't panic sell during a market dip, because the system keeps investing for you every month. Risk management and market crashes. Now let's talk about something that scares a lot of beginners: market crashes. It's normal for the stock market to drop sometimes, and it can feel scary when your portfolio loses value. But here's the truth: market downturns are part of the journey. For example, during the 2008 financial crisis, the S&P 500 lost almost 50% of its value. Sounds terrifying, right? But if you had stayed invested, by 2013, your portfolio would have fully recovered, and by 2023, it would have doubled since 2008. The key lesson here is simple: don't panic sell. Crashes aren't your enemy. Staying invested for the long term is what builds wealth. Think of it like planting a tree. It might face storms, but it keeps growing over the years. Wait, if you are really enjoying the video, like and subscribe to the channel. Now let's continue. Tax efficiency strategies. Next, let's talk taxes. And don't worry, I'll keep it simple. Investing in tax-advantaged accounts like 401ks and Roth IRAs can save you thousands over time. Here's why. 1. 401k contributions are pre-tax, which lowers your taxable income today. Your investments grow tax-deferred. 2. Roth IRA contributions are after tax, but your money grows tax-free, so you won't pay taxes when you withdraw in retirement. Using these accounts wisely is one of the easiest ways to keep more of your money working for you. Even small tax savings compound over decades. These are some common mistakes beginners make. Before we build your portfolio, let's cover some mistakes to avoid. 1. Chasing hot stocks. Just because something is trending doesn't mean it's safe. 2. Overtrading ETFs or funds. Buying and selling too often can eat up your returns. 3. Ignoring fees. Even small fees matter over decades. 4. Waiting too long. Every month you delay investing is missed growth. I know it's tempting to try to time the market or pick the next big stock, but discipline beats hype. Consistency is everything. How to build a simple retirement portfolio. Now let's actually look at how to build a beginner-friendly portfolio. Don't worry, I'll keep it simple. For someone in their 20s, 1. 80% stocks, mostly index funds like the S&P 500 or total market ETFs. 2. 20% bonds, to reduce risk a little. For someone in their 30s, slowly shift to 60% stocks, the 40% bonds as you get closer to retirement. A simple monthly contribution of $100–$500 into these funds will grow steadily over time. And the beauty is, you don't need to actively manage it, just set it and forget it. Let me use a real-life example to explain things to you. Jane, at 25 years, starts investing $200 per month into an S&P 500 ETF. She automates it, ignores market dips, and doesn't touch it for 10 years. After 10 years, her portfolio grows to about $40,000 without her doing anything complicated. The thing is, you don't need a lot of money to start, and you don't need to be a genius. You just need consistency, patience, and the right plan. Now, automation and psychology. Investing isn't just numbers, it's also about behavior. Humans are emotional. We panic when markets fall. We chase trends when we see others making money. Automation helps with this. By setting up automatic contributions, you avoid emotional mistakes, you build wealth steadily, you create a habit of saving without thinking about it. Think of it as putting your future self on autopilot. Your money keeps growing while you live your life. Let's look at making adjustments over time. As you grow older, your portfolio will need small tweaks. Increase your bond allocation in your 30s and 40s to reduce risk. Rebalance every year to maintain your target percentages. Adjust contributions if your income increases. The point is not to chase perfection. Small, consistent changes over time are what matter most. The power of dollar cost averaging. Another beginner-friendly strategy is dollar cost averaging. Instead of trying to buy at the perfect time, invest a fixed amount regularly. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this smooths out market volatility and reduces risk. This is exactly what most successful long-term investors do, without even thinking about it. Long-term mindset. Investing for retirement is a marathon, not a sprint. Don't focus on daily or weekly gains. Avoid comparing yourself to others. Keep your eyes on the 20 to 30-year horizon. The earlier you start, the easier it is to ride out market ups and downs. Patience and consistency are your biggest advantages. Summary and final tips. To recap: 1. Start early, even small contributions matter. 2. Use tax-advantaged accounts like 401k or Roth IRA. 3. Stick to low-cost index funds or ETFs. 4. Automate your investments to avoid emotional mistakes. 5. Don't panic during market dips. Stay long-term focused. Remember, investing is simple when you have a clear plan and follow it consistently. Now I want to hear from you. Which retirement account are you going to start with? How much will you contribute each month? Comment below. I like to read every comment and want to hear your plan. Also, if you found this guide helpful, hit the like button and subscribe to EduTech Finance channel for more beginner-friendly finance videos. And remember, the best time to start investing was yesterday. The second best time is today. Even $50 or $100 a month can grow into a life-changing nest egg over the next 30 to 40 years.